Good afternoon, and welcome to our webinar series, Rethinking Loan Qualification, the Power of Non-Agency Lending Solutions. I want to mention a couple of upcoming chapter events. We've got our next quarterly meeting, Empowering Better Futures for Aging and Special Needs Communities, on October 16th from 8 to 10 a.m. at the Buckhead Club. We've also got a mentor and mentee speed networking event on November 5th from 6 to 7 p.m. at Mutation Brewing. A webinar series, Social Security Essentials, How to Identify Opportunities Across Client Profiles, on November 17th from 12 to 1 via Zoom. Check our website for details, regular updates, and register now. We are thrilled to be joined today by Todd Shepard, owner and loan officer for Inspired Mortgage Brokers. Todd's been a residential broker for almost 30 years. Before we dive in, please use the Q&A feature at the bottom of your Zoom screen to share questions or comments throughout the session. We want this to be interactive and valuable for you. And with that, I'll turn it over to Todd to begin.
Thanks, Kathy. I want to thank everybody for sitting in today. We know that you're busy, so we're going to share some valuable information. But first, I want to just give Kathy such a shout out. I serve on the FPA board as a membership engagement director, and Kathy is such a rock star in this association, and she really puts everything together and makes everything go. So, Kathy, thank you so much for putting this together, but for everything you do for the FPA. Also, as members, we love to hear from you. We want to make your experience the best it can be. We want to hear from you about what type of topics, what type of speakers that you want to hear, what type of networking events. So please, there'll be a questionnaire, post-webinar questionnaire. Give us your feedback so that we can make this the best experience for you as possible. So with that said, let's get right on into it. A little bit about Inspired Mortgage Brokers. Yes, I've been a residential lender for almost 30 years. We're not quite there. And I've worked off and on over the past 25 years with my ex-wife Danielle, various stops. We worked for national banks, regional banks, correspondent lenders, started with a small broker shop. And about 3 years ago, we decided that to offer our clients the best rates, the best products, and really the best level of service and to be 100% in control of the customer service experience, we needed to go out and open our own company. And so that's what we did with Inspired Mortgage Brokers. Yes, I am a non-agency specialist, but it turns out most of the loans that we place, about 95%, are agency type loans, and we'll get into the difference between agency and non-agency loans. My background, before I got into the mortgage industry, I was a registered rep for 4 or 5 years with Equitable. So I do come from, and I'm going to use air quotes, a planning background. And I use that planning background whenever I have discussions with our clients and use a more holistic approach, looking at their entire financial picture to try to put together. I say my role is always to put together the most cost-effective, tax efficient financing with the least amount of stress. So our agenda today, we're going to talk about why non-agency matters, understanding non-agency, what it is, the non-agency pillars. There are 5 different loan programs that make up the non-agency space, how non-agency benefits you and your clients, and then talk about a few proactive strategies. I'm going to give some examples of how I've used some of these, but again, throughout, at any point, raise your hand, ask the question, would this fit for a specific client, or any kind of a clarification, because we are talking about loan programs, and I understand you guys are not lenders, you're not loan officers. So please, I want you to feel comfortable asking any questions, and I want you to get the most out of this. So why does non-agency matter to you? And what it's doing is it's financing the hidden gap in your client base. Millions of financially successful Americans, your clients, are routinely declined for conventional mortgages, and not because they can't afford the property, but because the agency lending system was designed for W-2 employees rather than entrepreneurs, investors, and high net worth individuals. So agency guidelines are very rigid when it comes to income documentation and what specific income documents that we can use. Just some statistics: over 16 million Americans are self-employed and they're struggling to qualify for conventional loans. 30% of the U.S. workforce is self-employed or earns non-traditional income, W-2, 1099 gig workers and things like that. And then the low reported income for many asset-rich clients by a deliberate tax strategy can create challenges. The irony that your clients face is the better tax strategy that you've designed for them, minimizing their taxable income and maximizing deductions and structuring through entities, the harder it becomes for them to qualify for a conventional mortgage, and non-agency loans were built specifically to bridge this gap. As their most trusted financial advisor, when your client says, I want to buy a $2 million home or I need to refinance my investment portfolio, you're one of the first calls they make. And if you don't have a clear path that accounts for their non-traditional income structure, you're leaving them and your practice underserved. So understanding the difference, conventional agency or qualified mortgage loans follows guidelines set by Fannie Mae, Freddie Mac, FHA, and VA. Um, and again, we always try to go with conventional financing for our clients when we can because those are going to offer lower rates. Non-agency loans are portfolio products. They're held by private lenders and funds, PE funds, hedge funds, and they allow far greater underwriting flexibility. In terms of debt to income ratios, conventional agency loans, the range is between 43 to 50% on that debt to income, basically the percentage of your income that you use to meet your expenses, like your mortgage payment, your car payments, student loans, credit cards. The regular uh, utilities or insurance and things like that are not included in that debt to income ratio calculation. The big difference between agency and non-agency is income documentation. For the conventional loans, we're looking at W-2s and tax returns for the last 2 years. With non-agency, we're talking about alternative income documentation, bank statements, 1099s, P&Ls, things of that nature. Another difference would be the loan size. Conventional loans have conforming loan limits by state and county. Same thing with FHA, same thing with VA. Non-agency loans offers loan amounts up to 5 million. So there's assisting with that luxury property eligibility. We can use these loans for primary residences, second homes, and investment properties as well. Why are the interest rates higher on non-agency loans versus agency loans? They carry a risk premium for two reasons. They cannot be sold to Fannie Mae or Freddie Mac and must be held in a portfolio or sold to private investors. And the alternative documentation introduces additional underwriting complexity. Rates are typically a quarter to a 0.5% above comparable agency products, but that's a reasonable trade-off for clients who otherwise have no financing path. For many clients, access to financing at a slightly higher rate is infinitely better than no financing. And I have found in certain scenarios, the pricing is actually the same on these non-agency programs as it would be on a standard jumbo conventional type of program. So whenever I speak to financial planners about these, a lot we'll do lunch and learns in their conference room, and they'll start maybe leaning back with their arms closed, crossed a little bit, thinking, "Oh, here we go again. Here comes the lending agency with all these subprime type of loans." These non-agency loans, they're not subprime. They're not the old ninja, no income, no doc loans. They're not liar loans, and they're not hard money loans. The rates are not, you know, 2, 3 points above what you would find in an agency situation. These non-agency loans are fully documented. They're underwritten to the ability to repay standards under the CFPB rules and issued by institutional lenders. The difference from agency lies in the type of income documentation, not in the credit quality or risk tolerance. As I said, they're not no-doc loans of the pre-crisis era. Every borrower must demonstrate genuine ability to repay through alternative means. These loans are not about helping someone qualify for a loan to buy a house that they don't qualify for. They're not about putting someone in a position to fail. And if you look there, the data from 2025, the average, this is the profile of your non-agency borrower in 2025. The average FICO or credit score was 700, which is definitely above the average credit score for an FHA borrower in 2025. The average CLTV or combined loan to value on the transaction was 68%. Again, that's going to be below the average for a conventional loan, certainly for a VA or FHA loan. And the average debt to income ratio was 35%. Again, well below what we see for conventional. Most of our borrowers are coming in on a conventional loan, usually around 40%, maybe 40, 45%. So again, this 35, these borrowers are not 2 days out of bankruptcy. We're not looking at 500 credit scores. We're looking for folks that obviously they have the money to make a large down payment. They have a low debt to income ratio, so they live within their means. It's just the nature of their income and the way that it's documented gives agency guidelines, conventional guidelines, a hard time. So we need to look at other options for them. And one thing before we go any further, I want to point out these non-agency type of loans, they're options for your clients, but probably more importantly, they can be options for their children as well. Um, Back to that 30% of American workers are self-employed. The adult children of your clients include that. By having a strategy to help those kids qualify, it removes the burden from the parents and it keeps the kids from coming to the bank of mom and dad, allowing them to keep more money invested. And writing a check for 500,000, 600,000 to help your child buy a house, that's bound to put some type of strain on that relationship as well. So keep that in mind as well as we talk about these products. It's not just for your clients, it's also for their kids as well. So these are the pillars of non-agency lending that we're going to talk about. These are the five different loan structures or underwriting structures. As we said, they are fully compliant, institutional grade loan products that use alternative income documentation to underwrite a borrower's ability to repay. And here are the five products you need to know. Asset-based or asset utilization loans. This is definitely where make sense underwriting comes into play. And that's the big difference between non-agency and agency. The lenders are able to use make sense, look at the whole picture and say, yes, this borrower is not a credit risk. They also have the ability to get exceptions and go a little bit outside of the guidelines if they were off by 1 or 2 points here on a debt to income or something like that. So it gives us a lot of flexibility. Bank statement loans, 1099 bank statement loans, P&L statement loans, and then the last DSCR, these are for investment properties. It stands for debt service coverage ratio. We'll get into each of these. Okay, the asset utilization feature. Finally, the perfect solution for individuals with a high net worth, those who are retired, or those with no income or employment, or those with meaningful assets. Earlier this year, I was approached by a financial planner. Their firm, they had 6 or 7 planners on their team, and they had recently converted from they had their team placed with a big wirehouse, and at the beginning of the year, they opened their own RIA. Because of that transition, this planner, he was paying himself a salary, but because he didn't have a year's history of that new W-2 at the new firm, conventional underwriting lending guidelines were not letting him use that. Also, he was taking distributions, but without a 2-year history of that 1099 distribution, whereas it had been a W-2 earlier, he had been turned down by 2 banks trying to purchase a home. So this planner was not retirement age. He was in his 40s, had substantial assets, and we were able to use these assets to help him qualify to purchase a home. Um, so this is a great program, and we're going to get into 2 different ways that we can use this. With the asset utilization, the attributes, we need a 660 minimum FICO or credit score. We can go up to 3.5 million on loan amounts. Loan to value to 80%. So we're going to require a 20% down payment on these loans. We have both a DTI, which is debt to income ratio option, and a no DTI qualification option. And there are 6 months seasoning requirements on all assets that we're going to use. Basically, the thought is we don't want you to have just won the lottery or, just inherited a bunch of money within the last 3 months. We want to verify that these individuals can handle managing those types of assets let them go out and buy the Bentley and do all those things and get all that out of their system and then make sure we have that 6 month seasoning. So the concept that we use here to determine what assets we can use are qualified assets. And the following personal assets are considered qualified assets and can be utilized to calculate the income. So we're going to be able to give them 100% credit for checking, savings, and money market accounts, 100% for trust assets when the borrower is the sole beneficiary, 80% of the value of stocks, and that's accounting for market fluctuations, and then 70% of retirement assets, and that's accounting for potential early withdrawal penalties, or income taxes. So, what we do is we chunk everything down in the different buckets, apply the discount rate to that asset type, and get to a total qualified asset amount for the borrower. Using the debt to income ratio approach, we're going to use the assets to generate income. We're going to get to a bottom line qualified income amount. Um, First, we have a minimum income requirement, and these are two separate calculations. The borrower must have a minimum of at least 1.5 times the loan balance, um, or 500,000 in qualified assets, both of which must be net of the down payment, the closing cost, and the required reserves to qualify. So we want to make sure they've got enough money to come to the table with closing cost, down payment, and still have sufficient reserves. Separately from that, we're going to come up with that net qualified asset amount, divide by 84 or 7 years, and that will produce our monthly income that we can use to help them qualify. So in this scenario, our borrower here, you'll see in the bottom right-hand corner, the number was 533,000 of net qualified assets. We divide that by 84, so their monthly income was $6,345. We can then stack that on top of other income sources such as Social Security, a pension. If they had a long-term note, let's say they had sold a business and they had a long-term note receivable, as long as they had received it at least a year and would be receiving it 3 years into the future, we could stack that income as well. So we can use this to help them qualify in addition to other income that they have. The second is more basically making sure they have enough assets to cover um, the loan amount, the down payment, basically saying, do you have enough cash that you could pay for the house outright? Do you have enough cash to cover the closing cost, reserves, and then enough money to meet all of your monthly obligations for 60 months or 5 years? So, as long as, and again, we're working with that qualified asset amount, as long as you can cover the loan amount, the down payment, the prepaids, the reserves, and then enough to cover your obligations for 5 years, then you qualify for the loan. We don't look at there's no debt to income ratio qualification or anything like that. And one thing I do want to point out, the minimum monthly obligations does not include the principal, interest, taxes, insurance, and homeowners association fee for the property that we're buying. It would include things that would show up on a credit report like car payments, student loans, payments on another property, mortgages, and things like that. All right, the bank statement loan. But before I move further, I want to point a couple things out. Each of these programs that we're talking about, the first four that we're talking about, we can use to help your borrower buy a primary residence, a second home, or an investment property. We can also close these in the name of a living trust or an LLC. With the DSCR, those are loans that are based on the debt service coverage ratio from an investment property. So obviously that loan is just for an investment property, but we can still close that in the name of an LLC. I just want to point that out. Okay, the bank statement loan. These are solutions for self-employed borrowers, business owners. And I'll give you an example. At the end of last year, we had a client, business owner, he owned 4 different businesses. 2 of them were more established and had excellent cash flow, and then 2 of them were startups. In one, he had revenue of over $1 million a year, and in the new startup, he had expenses of $1 million a year. So on his tax returns, he netted out no income. So he was not going to qualify with conventional financing. So what we did, we took the bank statements from just that one company that was generating over $1 million in revenue. We take 12 months of bank statements and we add up all of the deposits. We average that, divide by 12, and then back out a 50% expense ratio. So in his situation, excuse me, his average deposits were about 200,000 a month. We hit him with the 50% expense ratio, so his income for qualifying was 100,000 a month, and that's how we were able to qualify for the loan. He was using this to buy an investment property. It was over $1 million loan amount. So the rate on that at the time was exactly the same as it would have been for a fully documented jumbo loan because of the investment property situation there. So again, these rates can be very, very competitive. get into the nuts and bolts of it. So for any of these non-agency loans that we're going to talk about, when it comes to employment going forward, the income from self-employment is considered stable if the borrower has been self-employed for at least 2 years. However, less than 2 years can be considered with documentation of a minimum of 2 years of employment history in the same line of work or related profession. Less than 1 year may not be considered. Back to my original example, my first example of the planner that had moved over and created his own, opened his own RIA. Because he had 10-year history in the industry, we were able to go with that and use that to establish a 2-year self-employment history. So the documentation, the way that we do that with the bank statements, we can go with either 12 months or 24 months of complete business bank statements. Transaction history printouts are not acceptable. Um, and we go with 12 or 24 depending on if we need. We try to go 12. That's the simplest way. If they qualify with the 12-month, we go with that. If we need to stretch it out to 12, 24 months, maybe the previous year was a better year, then we have that option as well. 24 months, obviously we're going to average it over a 24-month history. We're still going to use that expense ratio. We have to verify that the borrower owns at least 25% of the business, and then we're going to apply that percentage of their business ownership to the monthly income. So back to the previous example, let's say we had a business that generated net after the expense ratio 100,000 a year. Our borrower owns 75% of that company, so the income we could give them would be 75,000 a month. They own 50%, we give them $50,000 a month. Two different options when it comes to qualifying the income. Again, the easiest is the 50% expense factor. If we qualify with that, we just move on. It's nice and easy, we're good. If that dings the income too much, then we can get an expense statement prepared by a third-party licensed tax professional that states that the expense ratio for this business is X, 30%, 25%, whatever. And we'll go into a little bit more detail. So again, we can use the 50% expense factor or an expense statement prepared by a third-party tax professional, which includes or is defined as a CPA, a tax attorney, an enrolled agent, or a paid tax professional, or a P10. Now, we do have to account for any large or unusual deposits. If they sold a vehicle or some equipment, or had a kind of an unusual one-time deposit, we would have to back that out of the deposits and reduce it by that amount, or get an explanation if this is something that they did on a regular basis. They end up selling a vehicle once a year, and it's not in this, for their case, it's not unusual, then we can make an exception. Okay, so we can also use personal bank statements. The advantage of this, and the reason we would do it, is it does not hit the calculation with an expense ratio. So we can give the borrower credit for 100% of those deposits. Again, we can go with 12 or 24 months of complete bank statements, and then we would use 2 months of the most recent business bank statements. This program is still designed for business owners and self-employed borrowers. It's not designed for, a salaried employee at Chick-fil-A or something like that. The statements must provide evidence that evidence activities to support business operations and transfers to the personal account being used. So we have to use those the business bank statements, to show that money is coming out of the business to our borrower's personal bank statements. And then, as I mentioned, we can use 100% of those deposits for income averaged over 12 or 24 months when analyzing the personal bank statement. So we look at the business, see if that works, 12 months with the 50% expense ratio. If that doesn't work, if we can get a letter from the CPA, and it is valid that the expense ratio is lower than 50%, if that works, if they qualify, then we go that way. And then we look at the personal bank statement option, because we don't get dinged with that expense factor. Now, if business bank statements are not available, then the loan must be submitted and qualified as a business bank statement documentation loan using personal bank statements. So we're going to use the personal bank statements, but we are going to apply that 50% expense ratio. The bank statement loan program attributes. Again, we need a 660 FICO credit score. With this, we can go up to 5 million. The minimum loan amount is 100,000. Here we can go up to 90% on a purchase or rate and term refinance. We can go up to an 80% loan to value for a cash out refinance. And the standard debt to income ratio is 50%, but we can go up to 55% for a primary residence. Again, primary residence, second home, and investment property. The one we closed at the end of the last year was an investment property. Uh, we can use this loan for single family properties, PUDs, which are single family homes in a planned community. Most homes are in a PUD. If you have HOA dues, you're a PUD. Townhomes, 2 to 4 units, condos, non-warrantable condos, and this is becoming a big issue because of changes Fannie, Freddie are bringing down the line. Most condo projects at the beginning of next year are probably going to run into the non-warrantable uh, classification, and so we're going to be doing more condos on these non-QM or non-agency loan platforms. Um, Log homes and modular homes, believe it or not. The we kind of covered this, but the personal bank statement analysis. We're going to use the personal accounts, use up to 100% of the qualified deposits, have to show the existence of a business account. And if there's no business account, we have to treat it as the personal loan as a business account and apply the expense factor. All right. The 1099 bank statement loan. This is going to be, and this one might be the one that would apply to your client's children more. You've got a gig worker, someone that maybe they do consulting work and maybe they work on different projects. Traveling nurse would run into this category. And so maybe they get multiple 1099s throughout the year, but they also have a lot of deductions. With this program, the income is calculated by adding the gross income of the 1099 before any deductions and the year-to-date bank statement income and divided by the applicable number of months with a 12-month minimum. So if we're doing this loan today, we're at the end of August. So we would get the 1099s from 2025 that say they have three 1099s. We would add up those three, the income from those three. We would take 7 months bank statements to get us through the end of July, add those deposits to the 1099 income and divide by 19. Last year plus 7, 19. And that gets us to the monthly income that we then use to qualify them with more standard lending guidelines. Another is the 1 year profit and loss statement. So the profit and loss must be prepared by a tax preparer's company on a tax preparer's company letterhead and must not contain any exculpatory language that may compromise the integrity of the information provided. Audited statements are not required, and that's a big one. These do not have to be audited profit and loss. So we can move more quickly, and your client's not going to come into a couple $1,000s of expense to get this audited. We have to do a reverse verification and validation of the tax preparer, validation of self-employment and business existence for a minimum of 2 years. Here with the profit and loss, we do need 2 years history. The way we calculate it, the net income is going to be the net income from the P&L times the borrower's percentage of ownership divided by 12 months. So if the net income was 120,000, the borrower owned 100% of the company, divided by 12, their monthly income is $10,000. If the net income from the entity is 120,000, the borrower owns 50%, then the income we could give them credit for would be $5,000. With the 1 year profit and loss, this works or is really comes into play because it is the most recent 12 calendar months profit and loss. So again, we're at the end of August. At this point, we would get a P&L through the end of July 2026, I guess August 1st to the end of July, August 1st, 2025 to the end of July here, this year. So that helps if you've got maybe a startup or a newer company where you're just getting started that first year, you didn't show a lot of revenue, you had a lot of expenses, so that first year P&L is not going to look so good. But you're coming into form, you're starting to earn more income, you've gotten past all of those startup costs, and now you're really showing some income and some revenue. That's where the 1 year P&L can help. All right, now the next we're going to talk about is the debt service coverage ratio, and this is going to be just for investment properties, and these are solutions for the real estate investor. With this debt service coverage ratio, the loan qualification is not based on personal income documentation. We do not enter any type of employment or income for the borrower. Everything is based on the rental income or proposed rental income of the property. Um, The loan is qualified based on the DSCR, debt service coverage ratio, where the borrower utilizes cash flow from the subject property only. There's no vacancy factor applied, whereas there's usually a 25% vacancy factor applied on conventional financing. And the debt service coverage ratio equals the gross income divided by the proposed PITIA, which is principal, interest, taxes, insurance, and homeowners association dues, if they're applicable. So, the example, if your rental income, gross rental income is 1,000, the PITI is 1,000, you have a 1.0 debt service coverage ratio. If the rental income is 750 and the PITI is 1,000, then we have a 0.75 debt service coverage ratio. We can still lend at the 0.75, but there are some loan to value limitations, and we'll get into that. Well, I do want to back up. These debt service coverage ratio loans can be used for short-term rentals, VRBOs, Airbnbs as well. Calculating the gross income. If there is an executed lease, we would use the lesser of the lease agreement or the rent from the appraisal on the Form 1007 or Form 1025. Otherwise, we use the market rent from the appraisal. So whenever we go to get an appraisal on an investment property, the appraiser is going to do what we call rent comps, and basically is going to look at other investment properties around that subject property and determine what kind of rents these other properties are receiving and give us a projected rental income for the property. Now, one caveat, if the executed lease agreement reflects a higher monthly rent, if there's a lease agreement in place, we can use that higher monthly rent when evidence of the most recent 3 months of rent receipts are provided. So in the case where we're doing a refinance, cash out refinance or something where the borrowers own the property for 3 months, it's very easy to document receipts. If it's a purchase situation and the seller has an executed lease and is willing and able to give us verification of rent receipts for the past 3 months to determine what that actual rent is, then we could use those higher rental payments. Excuse me. For interest only, now these loans do have an interest only option. The DSCR calculation allows for the use of the interest only payment, excluding escrows. Okay, program attributes. Again, the 660 minimum FICO. We can go up to 2.5 million in loan amount with a minimum of 100,000. We can go up to loan to value of 80%, cash out up to 80%. Foreign national borrowers are allowed, reserves of 3 to 6 months on the subject property only. This is big for real estate investors because they typically will have a portfolio and it might be, 4 to 6 properties. And if they have to have reserves for all of those properties, that could create a challenge. With the DSCR loan, they only have to have reserves for the subject property, the one that we're lending on. First-time investors are allowed. Gift funds are allowed. This is really big because with conventional lending guidelines, gift funds are not an acceptable source for a down payment to purchase an investment property. A Fannie Mae loan, a jumbo loan, anything like that, gift funds are not acceptable. They have to have their own funds. They can have unlimited finance properties. Again, conventional lending guidelines have limits on how many finance properties you can have and qualify for a conventional loan. As I had mentioned before, LLC vesting is allowed. Borrower entity, LLC, allowed. We can do this for single family residences, PUDs, townhomes, 2 to 4 units, condos, and non-warrantable condos. Short-term rentals are allowed, VRBOs and Airbnbs. All right. Now, if we do have that DSCR ratio under 1.0 down to 0.75, the minimum loan amount goes up to 250. We can only do these for purchases and rate and term refinances. They cannot pull cash out. The maximum loan to value is 70%, and we do need a minimum FICO of 70. The other caveat is we can only do these on long-term rentals. So if the DSCR is below 1%, we cannot do these on Airbnbs or VRBOs. This gets really, really granular, and this is more a me slide than a you slide because it talks about how we calculate the uh, the loan to value based on how long they've owned the property. I don't see how that's germane to this situation. All right, those are all the first mortgage products that we can talk about. Next, we're going to look at second mortgage solutions. Equity Advantage is a fixed rate second mortgage. It's a standalone second. It can be placed on a primary, second home, or investment property. Again, 660 minimum FICO for primary wage earner. Additional borrowers could go down to 620. So if we've got husband and wife, partners, whatever, um, 2 different borrowers, typically in the conventional world, we go with the lower of the 2 borrowers' representative scores to price the loan and to meet requirements. In this case, we can go with the primary wage earner if they have the higher score, as long as the other borrowers at 620 were in good shape. The minimum loan amount is 50,000. We can go up to loan amounts of 750,000. So this can be an option for someone, even a conventional type borrower. Most banks are going to cap out their equity lines at 200 to 250. With this program, if you've got someone that, let's say they want to buy a new home before they sell their current home and they've got a bunch of equity tied up, this would be a way for them to access that equity and make a large down payment on the new home, um, without having to sell that and then just pay this off, or pay it down when they've sold that home. Did we have a question, Kathy?
Yes. Just one moment.
Sure.
Is interest tax deductible if they itemize?
So it's still the same calculation, for your primary residence up to the first 750 of indebtedness. It is deductible. Actually, primary and second home falls into that. So that would apply to a first mortgage and a second mortgage. The second mortgage, if that second mortgage is used to acquire real estate, and I think that really kind of a lot of people use it if it's used to make improvements. For an investment property, that interest is going to be tax deductible on a Schedule C where you report the income from an investment property. It's going to offset that income. So, short answer is yes, all of it is tax deductible for the most part. It's just where you show it on the tax return. I hope that answers that.
Great. Thank you, Todd.
Sure. Okay, so yes, we can go up to 750,000 for a loan amount. Maximum combined loan to value. The combined loan to value is the combination of the outstanding balance on a first mortgage and a second mortgage. So if we have a property that's worth $1 million and we have a first mortgage at 500,000, the loan to value is 50%. If we add a $100,000 equity line, 500 plus 600 is the indebtedness, our combined loan to value goes to 60,000. That's what combined loan to value means. No reserves required. That's a big deal. For second homes, we can go up to 85% for combined loan to value. I don't know why it says CPTV for investment property, but we'll fix that. The combined loan to value for investment properties is 80%. Again, back to the situation, if someone wanted to buy another property, maybe a primary residence, they don't have maybe as much equity in their current home, but they have a lot of equity in an investment property. They could certainly access that investment property to make the down payment on the new home. Um, Proceeds of a secured loan are acceptable sources of down payments. Equity lines, anything secured by a non-retirement account, brokerage account, those are acceptable sources of down payment. Maximum debt to income ratio up to 50%. That's significant. Um, these come with 10-year, 15-year, 20-year, 25, and 30-year fixed. So this is a fixed rate closed in second. Again, single families, PUDs, townhomes, 2 to 4 units, condos, non-warrantable condos. Big, big deal. With this program, we can use a 12-month bank statement for self-employed borrowers. So that's another great feature of this fixed rate second. We can also, there's other sources as well. We can go with the one full documentation, 1 or 2 years W-2s and tax returns. The bank statements, either the 12-month personal or business. We can use a 1 year P&L and 2 months bank statements, or a 1 year P&L only with a 5% reduction in the loan to value of that equity line. Uh, and again, the maximum debt to income ratio allowed is 50%. All right. Here are the second mortgage solutions for the investor. This is basically a fixed rate second mortgage using the DSCR, the debt service coverage ratio calculation to qualify. Again, we're using the lesser of the estimated market rent from the uh, appraisal or the monthly rent from the existing lease. Higher monthly rents may be allowed with evidence of 3 months receipt. So we're just like the first mortgage there. Unfortunately, we cannot place an equity line on a short-term rental. That's just there's no appetite on Wall Street for that product right now. It may come around, but it's just not there and not available now. Um, and at the same, the qualifying credit score is the highest representative score for all borrowers or guarantees. So it doesn't even have to be the primary wage earner. You know, we're going with the higher score there. Again, that is a benefit. All right, this is the Equity Advantage HELOC home equity line of credit. So this is a line of credit. It is a variable rate product tied to prime. It is a line, so it's not fixed in that they can borrow against it again and again. So this could be good for a real estate investor that needs to make repairs or needs access to a line of credit for down payments to purchase other properties as they're buying and selling and things like that. So with this, we're going to need 1 year full documentation. Alternative income would be the 12-month business or personal bank statements. We need a 660 credit score for primary and second homes, so we can do these equity lines on primary and second homes. A lot of banks are limited to equity lines and second mortgages only on your primary residence. So again, provides more options for your clients. We need a 700 FICO for investment properties, and we can go up to a 50% debt to income ratio. With this one, the mortgage history 0 times 30 times 12 means that they can have 0 30-day late payments on their mortgage within the last 12 months. Basically, they have to be current the last 12 months and have not missed a mortgage payment in the last 12 months. So, who in your book of business benefits? We've talked about some examples. The business owner, that writes off nearly everything. They show 800 in taxable income on 600,000 in deposits, and they've been denied by the conventional lender. Very similar to the scenario that we closed at the end of the year. The solution is the bank statement loan using the 12 or 24-month business deposits with the expense factor, qualifying on the cash flow and not the tax reported income. The real estate investor, the challenge they have is depreciation, cost segregation, and expense deductions wipe out income on paper, which is their goal of every real estate investor. They want that Schedule C to show minimal income. And because of that, they cannot qualify for additional investment properties because they have those expenses. They have a mortgage payment, and they don't, on a conventional standpoint, they don't have the income to offset that mortgage payment. So they're kind of capped out. With these DSCR programs or other type loan programs, they do have the ability to expand their portfolio without paying cash. Again, as I said, the DSCR is a non-related non-QM product, qualify on the rental income, which I think we beat that dead horse. Um, the affluent retiree, and this kind of ties back into the planner that I talked about because he was not of retirement age. We needed to lean on those assets. They have 4 million in investment accounts, 2 million in retirement funds, fixed income of, I'm sorry, I can't, let me see. I can't see behind that amount. I'm going to say 6,000 from Social Security and dividends, and they want to buy a $1.5 million vacation property. The asset depletion loan is the option there. Assets divided over allowable terms creates additional monthly income, easily qualifying for the purchase, or just based on the assets alone, they may qualify without having to create any kind of income. So again, this allows that affluent individual to keep more invested with you, to keep more working in the market, um, so that they can buy that vacation property, that investment property, um, or even help, an adult child purchase a home. The gig earner, the income from multiple 1099 sources, inconsistent month to month, but strong income annually, because they have a complicated tax picture with variable deductions. Again, the bank statement averaging out, smooths out the inconsistency. The 1099 loan, it would work here as well. And perhaps the P&L loan for that 1099 gig worker. Whoop, sorry about that. Benefits to your practice, to being aware that these products are out there. It helps you become more of a full service advisor. It just adds a little bit more to your tool belt, as you will. You clients that are facing financing challenges or their children that are facing financing challenges might currently look elsewhere by being able to say, I know someone that can help you with that. It keeps every conversation and every referral inside your relationship. Um, it's a way to deepen client loyalty and retention. Solving a problem no one else could solve is the single most powerful loyalty building act in a professional services relationship, and non-agency can do that. Again, back to helping that adult child qualify for a loan that they wouldn't qualify for from an agency standpoint, and not having to write that big check, but letting the kids qualify on their own 2 feet, but still helping them with a down payment or something like that, is just a fantastic thing to be able to do. And then the tax strategy remains intact. They don't have to choose between paying less in taxes and qualifying for a mortgage. Non-agency lending is designed to accommodate, not penalize, smart tax planning. The folks that we're helping with these loans, again, they're not 500 credit scores right out of bankruptcy. These are folks that have really good accountants and they're very tax efficient, and they're being penalized by conventional lending standards. And then a tax strategy coordination. If you've got clients that are planning a large purchase 1 to 2 years out, you can work proactively. Um, they could use the bank statements, and you could advise to keep certain income flowing through personal rather than business accounts. Strategic coordination between tax planning and financing is premium advisory work. Um, Also, entity structure guidance. Bank statement lenders look at business income flows to the owner. Certain entity structures and distribution patterns qualify more favorably. So your guidance on structure, already part of your practice, can directly impact a client's ability to qualify for higher loans. And I'll leave you with a talking point as you're having your annual reviews, quarterly reviews. As you finalize your tax strategy for the year, you may want to flag something if you're planning property purchases within the next 12 to 18 months. There are financing products that qualify based on actual cash flow rather than your tax return, meaning we don't have to compromise your tax strategy to get you finance. So you just want to make sure you're coordinating both goals on that. That's it. And we do have some time for questions. I hope that you have questions. Um, you will get a copy of this deck. My contact information is there. Um, as any questions come up, anything, please reach out to me. I want you to feel comfortable. Um, with these programs, but I'm always available to answer any questions. And Kathy, did we just get a question?
We sure did. Can you address the HECMs or reverse mortgages and where they fit into the picture in terms of appropriate options?
Absolutely. As with these non-agency, we are set up to offer HECMs, reverse mortgages. Which HECM is the uh, FHA's reverse mortgage product, home equity conversion mortgage. We've closed a couple of them. They're not for everyone. I know a lot of reverse mortgage specialists, they will tend to push a lot of solutions that might be a good solution. But for the two that we've closed was a situation where because the reverse mortgage does not have a required mortgage payment, it really helped that retiree's cash flow. I mean, that freed up $2,000 a month that they weren't having to pull out of their IRA. Um, so that improved their cash flow. Um, we could do a completely another hour on reverse mortgages. There are some great features. Um, because of the growing line of credit, it can be a backstop. It can be a great source of funds in an emergency. It can be a great source of funds um, to offset sequence return risk. You can access the equity line when the market's down. When the market comes back, then you can pull the money out of the market and pay back the equity line. You can use it as an income stream. So there are a lot of places where a HECM is a good can be a good strategy. It's just important to know the entire situation. It is not a good strategy if the homeowner is not planning on staying on the home in the home for the long term because there are a lot of upfront costs. The mortgage insurance is expensive. So if it's a situation where I need a little money for a couple years and then I'm going to sell, it probably doesn't make sense. But it does. It certainly it needs to be included in the conversation to see if someone's maybe running short of income or maybe there's a concern that they would run short down the road. This can be a safety net for sure. I hope that answers that. But again, we could go into another hour of conversation about the reverse mortgages.
Great, Todd. Well, thanks again for your valuable insights. We appreciate your time and expertise. And a big thank you to everyone who joined us today. We truly appreciate your time and engagement. Be on the lookout for a follow-up email with the replay link, PowerPoint deck, and a brief survey. Your feedback helps us continue to deliver meaningful experiences. We really appreciate you all. Thanks for being a member of FPA of Georgia and have a great afternoon.
Thank you, everyone.